Hello, and thank you for joining us today for this Edward Jones webinar, Be Tax Smart, What You Need to Know Now. My name is Sandy Miller. Before we get going, let me highlight a few of the features on your screen that we're going to be using. On your screen right now, you should already see a video window with me inside. There should be another window with our presentation slides and a third window for our Q&A feature. If for some reason you have any difficulty during the program, you can click on the help icon at the bottom of your screen. That's the black question mark inside the yellow circle. This is for any technical questions you may have. We also have a team on standby ready to assist you if at any time during our discussion you have a question or would like clarification on a point. Just click on the Q&A icon, which is the third button from the left at the bottom of your screen. That will allow you to send in your questions. We will do our best to answer your questions in the allotted time we're given. If your question is not answered, please follow up with your Edward Jones financial advisor. If you do not have an Edward Jones financial advisor, please click on the Find an FA widget below. We also have a lot of helpful resources and information available for you inside the resources icon, which is located next to the Q&A icon. All right, now that you know your way around, let's get started. It's that time of year, tax season, and we're here to help make it as smooth as possible for you. In this webinar, our panelists will highlight the biggest changes year over year for the tax filing season, as well as some significant changes to retirement accounts resulting from the passage of the Secure Act 2.0. I'd like to introduce right now Edward Jones Senior Retirement Strategist, Catherine Tierney. And Catherine, welcome. Even though we file taxes year after year, I also know that tax time brings about some potential changes in the rules. What might impact our viewer taxes in 2022?
Great question, Sandy. Like years past, tax brackets, standard deduction amounts, and contribution limits for 401k plans were all adjusted for inflation. Contribution limits for IRAs stayed the same, but income thresholds for traditional IRA deductibility and Roth IRA eligibility also increased. To view the year-over-year amounts, check out the article titled 2023 Tax Season, What You Need to Know, that's linked under the resources icon Sandy mentioned earlier. The biggest changes from last year, though, are really the expiration of several COVID-19 tax breaks that were available in 2021, including the child tax credit. Last year, the maximum credit was higher, and it was available for children aged 17 or younger. It was also refundable, meaning you could receive the credit even if it was larger than the amount of taxes you owed. For 2022, the maximum credit reverts to its lower pre-2021 amount. It's only available for children aged 16 or younger, and it's only partially refundable. Next, the Child and Dependent Care Tax Credit. In 2021, the maximum credit allowed was higher, and the maximum income you could earn to qualify for the full credit was significantly higher. It was also refundable. Now, like the child tax credit, in 2022, this credit reverts to its lower pre-2021 value. It's only available to families making less than $15,000 before it starts to phase out, and it's non-refundable. Third, the Dependent Care Flexible Spending Account Limit. In 2021, the maximum amount a family could contribute to a dependent care FSA without paying taxes on the contributions was $10,500. For 2022, it reverts to the normal $5,000 per year limit. We also have the Earned Income Tax Credit. In 2021, more workers without children were able to claim the Earned Income Tax Credit, and the maximum credit was higher. Like the other credits, it too reverts to its pre-2021 terms, meaning fewer individuals will qualify and the maximum credit is lower. And lastly, charitable tax deductions. In 2021, a special deduction was available to non-itemizers. And for those who itemize, the limit that typically applies to deductions of cash contributions was temporarily waived. In 2022, though, the deduction for non-itemizers is no longer available. And for those who itemize, the normal deduction limit for cash donations to charities was reinstated. If you were able to take advantage of the more favorable tax credits last year, you could see a meaningful bump in your 2022 taxes.
Are there steps clients should take to prepare for their tax filing? And is there anything they can do to potentially lower their taxes?
Absolutely. To prepare for your tax filing, get your paperwork in order. To help with that, you can check out our tax filing checklist for a list of common documents and information you may need to complete your tax return, which is also linked in the resources icon. And given the expiration of so many tax breaks, you may want to plan for a larger tax bill or a smaller refund this year and reserve some extra cash to meet your potential tax liabilities. That being said, there are still some steps you may be able to take to lower your taxes. If you haven't already done so, consider making a 2022 IRA contribution. It could help you progress toward your retirement goals and lower your tax bill if you qualify for a deduction. You have until the tax filing deadline to do so. If you took a COVID-19 related distribution from a retirement account in 2020, you could also lower your tax bill by returning those funds to your retirement account by the tax filing deadline, including extensions. You can return these funds for up to 3 years from the day after you received your distribution, and they do not count towards the normal contribution limits. And finally, if you turned 72 in 2022, don't forget to take your required minimum distribution, or you'll face a 50% penalty for any undistributed funds. There are some changes coming for RMDs, which we'll talk about in a bit, but those changes are not effective for 2022. So if you turned 72 in 2022, you have until April 1st, 2023 to take your first RMD.
That's actually a good segue into our next topic, Secure 2.0. I'm sure clients have lots of questions about this recent law change. What do clients need to know?
Secure 2.0, which was signed into law on December 29th, contains more than 90 provisions designed to strengthen the retirement savings system by extending and expanding savings opportunities and easing administrative requirements. Now, not all of the changes in this bill are effective right away. In fact, the effective dates vary quite a bit, so you'll want to pay close attention to them throughout our discussion. The first change I'm going to highlight is, in my view, the biggest change of Secure 2.0, and it's one that takes effect in 2023. I alluded to it earlier, and that is the starting age for required minimum distributions, or RMDs, is increasing. If you're unfamiliar with RMDs, these are minimum distributions you're required to start taking from your 401k and traditional IRA once you reach a certain age. In 2023, that RMD beginning age is increasing from 72 to 73. This means that anyone who turns 72 in 2023 will not be required to start RMDs this year. The RMD age increase also applies to inherited IRAs with a spousal delay payout option. If the original account owner would have turned 72 in 2023, the surviving spouse does not need to start RMDs this year. However, as I mentioned earlier, it does not apply to individuals who turned 72 in 2022 and waited until 2023 to take their first RMD. Clients who turned 72 in 2022 must still take their first RMD by April 1st, 2023. The RMD age will eventually increase again to 75, but that second increase doesn't take effect until much further down the road in 2033. A couple of other RMD-related changes worth noting. The penalty for RMDs not taken is decreasing from 50% to 25% beginning in 2023. And beginning in 2024, RMDs will no longer be required from Roth employer plan accounts, aligning them with the RMD rules for Roth IRAs.
Okay, those are some very impactful changes for RMDs. What other changes are coming with Secure 2.0 clients that they should be aware of?
Secure 2.0 has a lot of changes for retirement contributions, including new or expanded tax savings for small employers to encourage employer plan access and participation, higher contribution limits for certain individuals, and enhanced flexibility for contributions. Let's start with the enhanced tax savings available to small employers beginning in 2023, which include an enhanced tax credit to help employers with 50 or fewer employees cover startup costs for a new employer plan, a new tax credit for employer contributions to startup plans also for employers with 50 or fewer employees, and new tax credits for military spouse participation and employer contributions made on their behalf. The military spouse tax credits are available to employers with 100 or fewer employees. Next, certain individuals will have access to higher contribution limits. Most of these changes aren't effective until 2024 or later. Beginning in 2024, the $1,000 IRA catch-up contribution available to individuals age 50 or older will be adjusted annually for inflation. Also beginning in 2024, participants of qualifying simple plans can contribute 110% of the normal contribution limits, while employers with simple plans can begin making additional non-elective contributions up to 10% of compensation or $5,000, whichever is less. And beginning in 2025, individuals aged 60 to 63 can make higher catch-up contributions in their employer plans. Lastly, there are several provisions of Secure 2.0 that provide greater flexibility for employer plan contributions. For example, defined contribution plans such as a 401k can offer participants the option to receive an employer contribution on a Roth basis effective immediately. Beginning in 2023, SEP and simple plans can accept Roth contributions, and beginning in 2024, employer matches are permitted for qualified student loan payments. Now, it's important to note that while the new law allows employer plans to offer these options, they are generally not required to do so. As a result, access to the plan options will generally depend on elections made by your employer. I should also note that while the new law allows SEP and simple plans to accept Roth contributions in 2023, Edward Jones is unable to accept Roth contributions to SEP and simple IRAs at this time, as we work to better understand this change and evaluate the impacts to our systems and processes. If these options do become available to you, though, they may offer you the ability to save more for retirement or to save in different ways than you could before. Be sure to monitor your plan for potential changes, especially towards the end of the year. And if you're uncertain whether they apply to your situation, your financial advisor can help.
All these changes seem like they're giving retirement savers more flexibility. Are there any areas becoming more restrictive as a result of this bill?
Yes, one aspect that's becoming more restrictive is the tax treatment of catch-up contributions for high-wage individuals. Beginning in 2024, participants with wages above $145,000 will only be permitted to make employer plan catch-up contributions on a Roth basis. This requirement does not apply to catch-up contributions to IRAs or to service-based catch-up contributions to 403B and governmental 457B plans.
All right, thanks for clarifying that, Catherine. Switching gears a bit now, I thought I read something about Secure 2.0 allowing 529 rollovers into Roth IRAs. Is that true?
It is true. Beginning in 2024, 529 assets may be rolled to a Roth IRA for the designated beneficiary of the 529 account, subject to certain eligibility criteria and limits. The intent of this change is to remove a barrier for education savings by providing greater flexibility for those assets if not needed for education expenses. While the enhanced flexibility is favorable, we do have several questions on how this provision works. For example, one of the eligibility requirements is that the 529 account must be open for at least 15 years prior to taking the distribution to be rolled over. However, it's unclear whether the account must be opened and maintained for that specific 529 beneficiary for at least 15 years. Ultimately, further regulatory guidance may be needed.
Any other changes coming with Secure 2.0 clients should be aware of?
The last set of changes I'll highlight relate to penalty exceptions for early withdrawals. If you take a withdrawal from your retirement account before age 59 and a half, a 10% early withdrawal penalty applies unless you qualify for an exception. Secure 2.0 is expanding the available penalty exceptions quite a bit, authorizing exceptions for federally declared disasters, terminal illness, personal or family emergencies, domestic abuse, and premiums for qualifying long-term care insurance. It's also expanding eligibility for an existing exception available to qualified public safety employees. While it may be necessary to take early distributions in certain situations, it is important to understand the trade-offs of withdrawing money from your retirement accounts early versus keeping it invested for your long-term goals. Your financial advisor can run different scenarios to highlight what may make the most sense for your unique situation.
Catherine, one final question for you today. How can financial advisors help clients during tax season and with the Secure 2.0 changes?
Your financial advisor can help you better understand these changes and how they may affect your current situation and your long-term financial goals. They can help you determine if any adjustments need to be made to your strategy, whether because of the rule changes or simply based on how you're progressing toward your goals to ensure you're on track toward retirement security. In addition, since many of these changes take effect over the next several years, it will be important to partner with your financial advisor to periodically review your situation over time. As with any decision involving taxes, though, you also want to consult with your tax professional on considerations and impacts to your specific tax situation, as your financial advisor cannot provide tax advice.
All right, Catherine Tierney, thank you so much for your time today. Some very helpful information. We appreciate it. Well, as I mentioned earlier, we have several resources that we hope will help you during this time. Be sure to check them out by going to the resource icon on your screen. We're now going to start the Q&A portion of the program. We have a team of subject matter experts waiting online to answer your questions through the Q&A widget. Please remember that there will not be any video during this portion. You will only see a slide prompting you that the Q&A is now in session. Rest assured the webinar is still live. We will do our best to answer your questions during the allotted time. If your question is not answered, please follow up with your Edward Jones financial advisor. If you do not have an Edward Jones financial advisor, please click on the Find an FA widget below. I also want to remind you that this broadcast will be available again on demand using the same link you used to register for today's program. Please note our upcoming webinar as well. Thanks again for joining us, and please enjoy the rest of your day.
you.